This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds to give us 5 stars on Spotify or Apple. This helps us with the search engine so that more folks can also discover and engage with all things microcap stocks. It is next week, the Planet MicroCap Showcase Vancouver in association with Small Cap Discoveries, happening September 25 and 26, 2024 at the Fairmont Waterfront, Vancouver. Presenting companies, speakers, everything is set. We got Paul Andreola, Brent Todd, Jesse Gamble, Matthew Martine, Ryan Irvin, Howard Leishman, all giving keynote presentations, as well as one of the best lineups of companies that not only we've ever put together, but I've seen. So if you can still make it in person, there is time to register. Please visit planetmicrocapshowcase.com. See you in Vancouver. Now, my guest on the show today is Jason Buck, CIO of Mutiny Funds. I met Jason at Ian Cassel's MicroCap Club Leadership Summit in Idaho in a classic random sitting in the back of the presentation conversation, happened to be sitting next to each other. Reason why we go to these events type interaction that ultimately leads to a podcast invite. We cover a ton, but mostly digging into Jason's background and how it inspired the best named investing strategy out there, the Cockroach Strategy. Thank you again for tuning into the Planet MicroCap Podcast, and please enjoy my conversation with Jason Buck. Jason, thank you for joining me today. How you doing, man?
Bobby, it's great to be on. I'm doing great. It's just podcasting in the middle of a Wednesday. What could be better?
What could be better? Look at us.
Or is it Thursday even? I don't even know what day it is. What day is it? Thursday?
It is actually.
Yes, Thursday.
If I closed my eyes, I would have thought it was Wednesday. You could have told me it was Friday. You could have told me it was Sunday. Like we should have
just ran with it. Now I sound like a moron, but that's hopefully what you're going to find throughout this. The disclaimer is not only does Bobby's disclaimer for investing advice, but nothing I say is advice in general. I don't have any original ideas. They're just copies of other people's ideas.
I knew this was going to be a fun one. I posted on Twitter, this is about to be a banger, all that kind of stuff. But it was mostly because like when we first met, and shout out to Ian, we happened to just be sitting next to each other at his recent MicroCap Leadership Summit in Idaho. And we just started shooting the shit. And I was like, wait, Jason Buck, like Pirates podcast, with Corey. Wait, am I part of the booty crew? Sorry, we were talking about that offline. I had to say that because I think that's hilarious. Yeah, man, I had to have you on just to, look, there might be some of my audience that has never heard either any of your pods before, or heard you as a guest, or know about your strategy over at Mutiny Funds. So, look, love to start us off just real quick for those that, don't know you, haven't listened to the podcast or anything like that before, love to learn where your passion for investing began, your background, how you cut your teeth to where you got to where you're at today.
No, that's great. And, I feel like we're going to, probably, give too much kudos to Ian Cassel, but it was great being at his event. It was really eye-opening to me. And I find, like we were talking about before, is like there's these, I traffic in the esoterica more of defensive strategies like derivatives, options, and managed futures. But similarly, like, microcap world's, trafficking in the esoterica. We're all on like these fringes of the investing community, but I found the people very like-minded. So it was really refreshing for me. So, and it relates kind of to what I do. It's very similar kind of to microcap investing in a way. Like, it's really about thinking long term and thinking about what are your downside risks and really doing your due diligence. And I usually say all the time that like nobody does due diligence because I just see it all the time on the institutional side and everything. So that's really refreshing being around microcap people that actually do due diligence. It's great to see like they actually do their own work. It was really refreshing for me to see. So I started off, I've been, investor, just like I think most stereotypical stories, like, talked my dad into opening a brokerage account for me when I was like 13 years old, so I could buy my first stock. And I remember, I can't even remember where I read it, but it was something like, China's opening up, there's going to be, billions of people opening up that market. They're going to need modern, American style toilets. So I'm like, that's it. I'm buying American standard toilets, like that's my stock pick. I'm sure it just went absolutely horribly over time, but like that, at 13, that was where I started thinking about, I guess, investing in stocks. And then I tend to split the world around in two ways of basically people usually get the aha or epiphany moment for investing. They either read Warren Buffett's books, what I think a lot of microcap people do. The other one, I say the flip side of that, is the Market Wizards books by Jack Schwager that really detailed a lot of commodity trend followers and CTAs, people that traded the more managed futures markets. And those give you two very different perspectives about the way to look at markets, because what's typical in the CTA world is trend following, where they buy high and sell even higher, or sell low and then buy back even lower. So it's like trending is very different from like that mean reversion of buy low, sell high that you get from that value community. But what's interesting, I think, when you read the Market Wizards books, maybe first, is you do learn that everybody has a different investing style. And what's most important is to find the style that works for you and kind of stick with that. And I think that's what Buffett's done extremely well, is having that same style for 6, 7 decades. That's what we've never really seen before, is somebody compounding that similar style through thick or thin. And so I think it kind of dovetails both that way. So I was more focused on that kind of managed futures side, and eventually taught myself how to be an options trader as well. But I was always just an entrepreneur at heart, from, selling bracelets in middle school to mixtapes, that I would stay up at night, like set my alarm for when Yo MTV Raps would come on. I'm really dating myself, but that would make mixtapes and sell those at school. Shout out to MTV. Hopefully this, enough times pass where they can't come after me for selling mixtapes in school from MTV Raps. But eventually I was a soccer player. I lived at the IMG Academy. I played soccer at College of Charleston, and I fell in love with the Charleston, South Carolina area. And post-college, I eventually became a commercial real estate developer. And so that's what I find so like-minded community with microcaps, is a lot of the microcap investors are, entrepreneurs, business owners, or former entrepreneurs and business owners, which I always love, is people that have at least that experience of operating before they're an investor. And so I was a commercial real estate developer in Charleston, South Carolina, helped develop a lot of that King Street corridor that's so famous today. But when I started out there wasn't a single national chain store in Charleston. But going into the great financial crisis, the 2007, 2008, and I say that specifically 2007, 2008, because 2007 was for real estate guys, 2008 was for stock guys. And so people will remember the tremendous pain of that. And, what happened is, going into that, I kind of blew up, my commercial real estate development company. And a lot of people think it's due to leverage. And that is true. There's a lot of leverage in real estate, and that's why people love it. But to me, it was much more time horizon. And that's what we can get into too. And like, I never wanted to feel that pain again. And I thought, if global liquidity dries up in like these GFC events or March 2020, is like, there's got to be a way to hedge entrepreneurial risk, right? Because if I'm developing property or I have a business, I'm taking very idiosyncratic risks based on my locale and the business I'm in. I can't really worry about what's going on in the global macro environment. That's just like 2 steps removed, and it makes it very difficult. So I thought there had to be a way to kind of hedge out that global macro risk, so that way I could be much more aggressive as an entrepreneur. And so I spent the better part of the next decade. I taught myself how to trade, VIX futures, different derivative option strategies, et cetera. And I was really building portfolios for family and friends that, could really hedge out a lot of those risks. And then just over time, I found, I'm probably a better entrepreneur than I am a trader. And I just got tired of, friends and family reading, Nassim Taleb books or Mart Spitznagel or other more modern books that we've seen about, tail risk hedging. And they asked me, great, I want to do this. It makes a lot of sense to me. How do I do it? And it's like, if you don't have over $100 million, none of these managers are talking to you. This is a very institutional asset class. And seeing how I already knew kind of the pitfalls and how to put these trades on, I just figured there had to be a way to give accredited retail clients like my family and friends access to these products. And so, that's what not only learning about the space, but then figuring out how to build a business in the space. And maybe we'll get into that too, is like the investment business is very different from the trading business. I likened it to, I used to own restaurants. And I remember in the restaurant business, you have huge failure rates in the restaurant business, because that's a lot of times people are like, oh, you're a great home cook. Like you should be a chef and start a restaurant. No, that's a terrible idea. Or they're like, you're a good maitre d', like you should open a restaurant. You know how to throw a party. Once again, terrible idea, because it's really the business of running a restaurant. And I find it's very similar in the investment management business. Everybody thinks they're a great trader. And I'm sure you see this all the time in microcaps, when people go from, their basement to then run a business. The business of investment management with compliance and clients and all those things is a very difficult business side. So figured out, what the structure and the wrapper would look like to be able to offer this to, accredited retail clients. And then going into 2020, we're trying to launch our long volatility fund. Nobody was interested until March 2020 happened. It subsequently launched our long volatility strategy, and then since then, in September 21, we launched our Cockroach Fund, which is like our total portfolio solution. So I know that's extremely long-winded, but that's kind of the general perspective I take. It comes from a much more entrepreneurial perspective of hedging kind of your global liquidity risk, and more importantly, it's like, how do I reduce my reliance on luck? I always talk about, the entire industry talks about investments. I think it is savings, right? Like as a business owner or entrepreneur or just any person in general, it's like, after production, you have consumption, whatever is left over is your savings. If you can't put that back in your business to grow it, you need to put it somewhere else, and you shouldn't take imprudent risk with it. And a lot of people don't realize, in a much more philosophical or holistic perspective, that their business is really an equity-like business, right? And so you should not be using your savings to probably invest in more in equities. You should be looking for some defense or some maybe like bond or T-bill like returns for them savings.
Man, wow. See, this is how I know I'm talking to an awesome podcaster. Like I'll just tee you up and you could go forever. And wow, there's so many different rabbit holes. But we locked in on something that I feel like I want to dig into real quick, is the shift from when you're like, all right, I think I have some, basically like, okay, I'm a talented trader, assuming, right? Feeling the confidence, like I want to now switch this over to offer this up to family and friends, run a real investment management business. What were some of the key, I guess, learning lessons when you went from, all right, doing this kind of on my own, making money, doing what I got to do, to now like, all right, but I want to really be an entrepreneur and turn this into an investment management business? Love to hear your thoughts there.
Yeah, I almost had a knee-jerk reaction when you said successful trader, because I think we all know this is
I'm just,
No, because what we do know is like all I think about is I try to suck less every day than being successful, right? Like that's what I can manage. And that's what we learn as traders is like you make terrible mistakes and then you try to make less of those mistakes over time. It's like, do you ever become successful? Or to me, surviving is the only success in this business. So I just try to suck less every day. And that even as a trader, it's like you make dumb mistakes, and hopefully learn from them and make less of those mistakes, knowing you're going to make future mistakes that you never thought of before. And it's just it's a weird thing that we always talk about success. And it's like, I don't know, we just try to suck less every day. And then what I love about going back to Ian Cassel, when he always talks about this stuff, and then you've had like Brian Bears on your podcast too, and I could listen to those two all day long.
Oh my
but
gosh.
I love when they talk about like building their businesses. And so similar to Brian is like, I don't know, I spent not only like years like figuring out how to trade and what these instrument looks like, and like you said, I paid that tuition just like we all do in trading by losing money. That's how you suck less, right? The pain of losing money makes you strive to be better. And eventually, when it became time to build out this business, I had to think about what is the specific vehicle or wrapper about this. And actually, I had a great conversation on the bus when we were in Utah with the Kingdom Capital guys, with David and Michael over there. Great guys. I love talking to them about this. And we're always, whether you go SMA route, right? Do you go a fund route? Do you do a 40 Act? And you talk about this all the time in your podcast, which I appreciate, because like to me, this is the information that's really hard to find. And this is what we all actually care about when we're thinking about going down these avenues. And one of the ones I always talk about all the time is like everybody was always telling me to, we want an ETF. Like I get that. But on a lot of like this esoteric stuff, you're still going to pay taxes like it's not an ETF, and people don't realize. And then two, people don't realize that ETF providers don't make money. Like Vanguard is able to charge those tiny bips because like they have such a large AUM. But unless you have a clear path on an ETF to be over $1 billion in management, you're not going to make much money. In those first few years, you're going to lose a lot of money, or you better have a good capital base to build that. And you're going to start with 250,000 to 500,000 just to get an ETF off the ground. And then you have the similar amount of that in compliance every year. So it's just much more difficult. So why I bring that up is like, I explored all of those avenues and what they would look like. And one of those avenues that's difficult for hedge funds and why they've been so prohibitive for most people is under the SEC rules, you have 99, you're limited to 99 accredited investors. Now, if we get into QEP or QP, you can change those rules a little bit, but now the requirements for their actual net worth get higher and higher. So what I figured out over the years of doing just tons of research is if we set up what we do as what's called a commodity pool operation, or CPO, which is kind of under the NFA and FINRA on that side, and you're exempt from SEC if you don't trade securities, you could take unlimited accredited investors. And so that's what took me years to kind of figure that out, to be able to offer what we do to accredited retail clients at like $100,000 check size, because then I know I'm going to need thousands of clients to get to where we want to go. I can't have that 99 limit to be able to offer this to people like my friends and family that, maybe didn't go to Ivy League schools or Goldman Sachs and those sorts of things. And so it was really figuring out that process. And through that process, I was always sourcing and talking to other volatility and options managers, going back to 2014, 2015, while I was doing this myself, I was always seeing what the landscape looked like. And just like MicroCap, it's a very small universe of people. Like right now, there's probably 35-ish, like kind of long volatility and tail risk managers that we track. And that's pretty much the entire space. We allocate to 14 of them. So once again, it's a narrow niche, or like we said, we're on the periphery as well. But one of the things I learned from, talking to all them and talking to what we use now as kind of our back office partner with RCM Alternatives out of Chicago, was if I wanted to set up this commodity pool, I had to figure out, how do I mitigate my risks? Because I think about it from an entrepreneurial perspective, is like, you always have those great ideas. Like, you're in a restaurant or you're at a shop and you're like, this sucks. Like, somebody should fix this. And you're like, I could fix this. Here's a brilliant idea to fix it. And you go, if I had $1 million, I could fix this. And you're like, okay, most people could. So then you marinate on that idea. You start to reduce risk, because entrepreneurs aren't risk takers, we're risk mitigators, right? And so you work on the idea, maybe 6 months later, you're like, okay, I could do this idea, but now it requires $150,000. And you go, okay, let me marinate on this. I work on this idea. You get it down to enough cost where you're like, I have to take this risk, right? You've risk mitigated enough where you could. And so I try to interview a lot of back office partners, and I figured out if I could use economies of scale with some of them, I could, kind of use their in-house legal teams, et cetera, to almost use like a pseudo incubator to like kind of get this off the ground. And then, that way it wouldn't have too much prohibitive costs where I'd have a, ton of sunk costs I was trying to make up for. And so we built it so our fund could be cash flow positive from day one. The other road bump we ran into, though, is when you're going to launch a fund like this and you're using like institutional quality allocation strategies, a lot of these niche managers are going to require institutional quality clients. And that means like qualified purchasers or QEP onlys. And so to be able to launch a fund like ours, we had to amass $5 million for the fund to qualify in aggregate so that way some of these managers could actually take our allocations. And so we got a lot of our paperwork done at the beginning of 2019. I think it took most of 2019 for our lawyers to work it through, because we're a very unique fund. It's never really quite been done before. And so we were pitching to family and friends and trying to aggregate that $5 million. And so for probably a year, we probably were sitting right around just shy of $3 million between family and friends. We knew we needed to get that 5 million. So as you know, and as an entrepreneur, it's just like dire straits. You're like, we've pulled every, string we could pull. We've turned over every rock. Like, this is never going to happen. And then March 2020 happens. And then now all of a sudden, nobody else was interested in long volatility and tail risk or that insurance until after the flood. And then we told them, I don't have a time machine. I can't go back for you, but I'm happy to get launched. But now we're launching into a high vol environment. This could be, a bit of a struggle from here. But like, that's what really got the inflows to get us above that 5 million and finally get launched on April 17th of 2020.
Very good. I mean, I'm so curious as to what that initial pitch was like to, because like you said, this is kind of back in 2019, like this was a strategy that had never, been done before as you guys were setting it up. What was those conversations like then just to even get to the 3 million?
It's a phenomenal question, because like, it's not only that, like, you're selling a dream, right? Like, you don't have a track record or anything like that in a way, right? And so I always operate by the mantra, like, be so good they can't ignore you, right? Like, we know our space so well, and probably better than anybody on the planet, that like, you can't ignore the way, like, our ability to assess the long volatility tail risk and like commodity space. Like, we just know it better than anybody else with the team we built. So that's part of it, is really knowing all of, like we're saying, like the due diligence. That's why I love the MicroCap. Like, they know their businesses that they're investing in better than anybody else on the planet. And that's what we try to focus on. The other part of it was, you don't like, because we don't, like I said, I didn't go to Wharton, to UPenn, and then go work at Goldman Sachs, and then go work at a hedge fund, and then launch my business. Like, we come from completely outside the industry. But I think that's what it took from guys from outside the industry that wanted to set this up. Meanwhile, if it was people inside the industry, they start at those $100 million minimums, right? To offer this accredited retail, you needed a creative entrepreneur from outside the industry that was going to look for all of the ways and workarounds to be able to actually bring this to the retail client, and so part of that brain damage and that education curve that was required in the hand-to-hand combat to sell this to to smaller investors. And so we knew that was our edge and our blue ocean. And so we knew it was going to take a lot of work and a lot of time to do that. So we built up a compendium of content, right? These essays, podcasts, all the work we were doing, everything that gave, all of that background for the education curve. The other way we were kind of able to overcome that hurdle is like, we look for clients that have at least read like Black Swan by Nassim Taleb or other books along those lines. Like to me, it's like, if you haven't read that stuff, you're not desperately looking for it, you're not interested in what we do. I can't go up to somebody on the street and say, "Hey, you should have portfolio insurance and hedge your portfolio and have this premium drag on your portfolio that then, saves your bacon when you need it most, but on a 10-year risk on period, you're going to hate writing those checks," right? Like nobody's interested in that a priori. It's like we are trying to find the clients that are desperately looking for that. So the way I think about it is like I'm trying to fire 99% of the people that come in that find us, right? Because like I need to make sure you truly understand what we do, and that's part of the education and the amount of content we put out. That this is exactly what you're looking for, because we want sticky clients that are going to be with us for the long term as well. And so it's really just that real hand-to-hand combat, going through all that, and then just turn over every rock, being on every podcast, just talking to everybody you could. And it's so funny because like now in hindsight, and I'm sure even like Brian Bears, I'm sure if you asked him too, it's like you look back and these are so easy stories to like gloss over, and it's like, how'd you get there? But it's just like, man, at the time it was like it seemed impossible, and even looking back now, it seems impossible. But eventually, you turn over enough stones, you catch some wins, and then you hopefully compound those wins, and then you hopefully hit a J curve to get it off the ground.
100%. And I mean, that's one of the reasons why I love having the show, so that we can kind of dig through, because you're right. I mean, early on when we started the pod, and we'll get there obviously when it comes to like philosophy and the strategy and all that kind of stuff. But, we forget that, you, Ian's, Brian's, you guys are running businesses as well. And just how you got to where you're at today is also quite fascinating. But, I'm actually pretty curious, like when you were putting together the volatility strategy and the commodity trend strategy, did you have the cockroach and defense strategy also in the back of your mind, like just in case, hey, all right, here we go, the inflection point happened, like the floodgates are out? Did you have those other strategies in mind to want to launch once you do get over the 5 million and it's like, okay, we got to diversify our product offering?
That's a great question. Yeah, we debated it like a lot internally, like, do we launch with our full total portfolio solution with Cockroach, or just this sleeve or bucket of long volatility? And we were back and forth, and we just felt like the piece that was missing from most people's portfolios, or the one they couldn't get access to, was the long volatility sleeve. So that's what we went with first. I kind of wish we would have started with the Cockroach fund, just because like that total portfolio solution is much easier for people to palate, like over the long term, over months and quarters, and kind of it muddles along kind of the different macro regimes that we'll get into.
It's an easier hook for sure.
Yeah, and it's just more sustainable for ourselves and for the clients. And even though we can really express our entire philosophy with the Cockroach Fund, and say, hey, you've got these other pieces, here's your long volatility sleeve, and you need to rebalance it and all this stuff. It's one, behaviorally, will people rebalance? And two, do they forget, right? Like, so it's just much easier for us to manage it in-house for them and make sure that philosophy and that broad diversification is much tighter. And so that's kind of what we fumbled with, but it was always, the Cockroach strategy was always in the back of my mind, because one, I had, going back to the market wizards, been infatuated with managed futures and trend following, and done that since late teen years. And then more importantly, I always was fascinated by Harry Brown's permanent portfolio that he came up with in the 1970s that really managed that 4-quadrant model. So that's what we kind of, the rubric or framework we use for broad diversification. And then Dalio kind of copied his work and everything, but we can get into all that. But like, so it was always long volatility within this overarching framework or the Cockroach philosophy. But yeah, it's debatable what you launch with first, right? And there's never a good choice as an entrepreneur. And in hindsight, you would have probably done, 5,000 things differently.
100%. Well, I mean, look, at the end of the day, like the long volatility thesis actually played out so that you could get fully launched. And like the Cockroach, yeah, it's differentiated, but I think more investors would be like, all right, like, I've heard of variations of what you're talking about here, versus, okay, launching with the volatility, it plays out a little lucky, if we're being totally honest, right?
Yeah.
I mean, that was a black swan event with COVID and everything, so in a way, it actually kind of, well, not in a way, it did work out.
Yeah, and as you know too, it's like a lot of times you want to start really narrow niche, right?
Yeah.
And then you can broaden afterwards. Like you want to just be the best, like I said, be so good they can't ignore you in this narrow niche.
Mm-hmm.
and that's what everybody knows you for, and then you can broaden out after the
Oh, I
fact.
think about it all the time with what we do here, right? Like we're set in microcap and been doing it for years. It's like, do we stick to just that? Do we expand a little to small cap? But to be honest, I don't know. I love small microcap way too much. That like, if we were to try and do stuff in larger, like it just doesn't, we don't need to. It doesn't make sense. That's not why people come to. Anyways, enough about me. Let's get into the cockroach strategy a little bit. Want to learn a little bit more? Can you tell us about the philosophy, how you arrived there? You already mentioned some of your inspirations for it, but from the horse's mouth, give us the full pitch.
Yeah, so I mentioned Harry Brown, and in the 1970s, he came out with what they call the permanent portfolio, which was like a four quadrant model. And the idea of the four quadrants is in any macro environment, we're on the axes of growth and inflation. And that gives us four quadrants, right? We're in growth or recession, inflation or deflation. And they kind of overlap and overlay like a Venn diagram, where you might be in a little bit of both. But that's generally the four macro quadrants. And what Harry Brown did in the 1970s to manage those quadrants for growth, he used stocks. For inflation, he used gold. For recessions, he used cash. And for deflation, he used bonds. And that's how he, put them in equal weights, 25% each in each of those buckets. And then he would rebalance, like it wasn't once a year. Actually, he used rebalancing bands. So if any of the buckets got, 10% out of whack, then he'd rebalance. And that worked out to about every 1.3 years. And if you look at these portfolios, they do great. They kind of muddle along kind of each decade. They have, kind of positive real returns. But people tend not to like them because they might underperform the stock market or 60-40 in any given year or any given few years. But they tend to really do well to, kind of outpace inflation. And that's, to me, what you need most from your savings. But they're very boring, right? They're not very exciting. And so that was the premise for the four quadrant model. And then Ray Dalio, like I said, kind of copied that model. And then he use risk parity, which means just levering up the bond piece, like looking at the correlations and the volatility, or I like to call it variance as it is instead of volatility, but it's just the variance of that portfolio. It allows you to, theoretically levered up the bond piece. So that's what they did with, his all-weather kind of risk parity portfolio that got a lot more fame. I tend to prefer the kind of equal weight of Harry Brown's perspective, because you really don't know what can go wrong. And I was actually banging that drum prior to 2020, because if you look at the long arc of stock and bond correlations, it's actually more than 50% of the time they're correlated, and it usually tend to happen in inflationary environments. But if you look at 150 years of data, they're more correlated than they are uncorrelated. We just went through this 40 years Goldilocks with these 60-40 portfolios where stocks and bonds were negatively correlated, which is great for your portfolio. So I was always kind of worried about what could happen in 2022 if you had that leverage portion. So I just thought if Harry Brown were alive today, using the modern tools, what we have, what would you do differently? So our four quadrant model, what we do is for stocks, we use global stocks instead of just domestic, which we view as the right thing to do long term, but like looks terrible in the last 5 years, right? You're getting hamstrung. Talking to a microcap guy, I don't have to talk about basis risk and veering away from benchmarks. You get it. So for the growth part, we use global stocks. For the deflationary part with bonds, we use global bonds as well and other income-like strategies, because you want an income, more of a deterministic income in a deflationary or disinflationary environment. For inflation, instead of just using gold, which is just one path dependency, this is where we use those commodity trend followers that trade managed futures. And in managed futures, you have like 60 plus markets that are across all commodities, agricultures, metals, FX. So you're getting that broad swath of those inputs that can lead to inflation. So we feel that commodity trend following, going both long and short, all those markets, has a much higher beta to inflation than necessarily gold can have over time. It doesn't guarantee it, but it has a nice higher beta to inflation. And then for the recessionary times, instead of just cash, which I think cash is fantastic, but you have to hold a lot of cash to balance that portfolio, where if you use kind of tail risk put options, it's almost like an insurance premium that you have on like your house or car, you're paying a little bit out every year to have a real convex ability to convert that to cash when the markets tank off. And so that provides, we think, a better exposure to a recessionary environment or those really acute liquidity events. But the way to also look at it is like you have these very linear positions on a risk on environment, which we just call offense, right? And most people portfolios are entirely offense, right? They're entirely stocks and bonds. And they go, no, I have broad diversification here. They show me this pie chart and I look at it and it's like stocks, bonds, private equity, private credit, real estate, venture capital. I'm like, those are all offense. Like those private equity, venture capital, you may think they're uncorrelated or whatever, but as soon as correlations go to one, there's a liquidity event. They're the same as stocks. They're really just a leveraged stock position. And so those all go down together. So most people people's portfolio are entirely in offense. And so we like to work on the defensive portion of that portfolio. Like we say, offense wins games, but defense wins investing championships. Is if you think about when the stock markets really sell off beyond that negative 20% drawdown, that's when people really start to capitulate and get very fearful. Well, if we can pair that off with like, tail risk put options that really start kicking in and truncate that left tail to that negative 20%, that's a great balance to that portfolio. And then you think about the other linear offensive asset with bonds or income is, those get really hurt by an inflationary environment. Well, that's when your commodity trend followers tend to kick in, and there's a lot of convexity to their P&Ls as well. So you're pairing this kind of linear risk on offense with this convex risk off defense. And we view, that's a great pairing to look at a portfolio. And then we think about it from a correlation level. Ray Dalio also said you want 16 uncorrelated return streams. Now, that'd be great if that was possible. I don't believe it is. You either have correlated, uncorrelated, or negatively correlated, and you find out what correlations are because they're conditional when you have a sell-off. And so we try to think about that in a much more philosophical terms than counting on, any kind of convenient correlation for the last, quarter or year. We try to focus on, what's really the raw correlations when they become conditional when you have liquidity events.
You kind of just hit on my next question right there, because there's that. Because one thing we think about also as a microcap investor is, everybody tries to be, everyone wants to be a contrarian, right? We want to start looking at markets when things are just absolutely hated. For instance, cannabis right now, just completely hated, just using that as an example. But you can find some companies that are actually making money and stuff like that. So when you're thinking about putting together this holistic portfolio, when you're putting this together for, both for your clients, what data points are you looking at to assess, to say, okay, this is where maybe we should be placing more of our bets right now as part of our defensive strategy, because this is what people this is what's hot right now, or something? Like, simplify it a little bit more for the layman that is really trying to understand what you mean by the holistic approach. And by layman, I mean me.
Yeah. At a very high level, I think that, thankfully, we've always kind of had these quadrants, and you guys have what style boxes or style drift, and none of that really makes sense. And, all of us, when we boil down to, is like, what box do I put it in? It's kind of crossing over into this box. It becomes very murky when you really try to assess that. So at the high level, we just try to think of offensive and defensive assets. And so, like I said, the stocks and bonds are going to do great in an offensive environment. And that's what's interesting. Like you said, contrarian is a great word. Is like, that's why the microcap people in my tribe, because like I feel like I'm very contrarian in general, but if you know anything as a contrarian, is that consensus is usually right most of the time. And so it doesn't help you that much to be a contrarian. But what you can do, at least for us from the contrarian on the defensive side, is to admit that, bad shit does happen, and maybe you want to prepare for it. So what I'm saying is, like, we just like to ride that offense. They a lot of times can happen 5, 10, 15 years. The market can stay insolvent, irrational more longer than you can stay solvent. It's like, we're not betting against the market. We're not perma bears, right? Like, stocks and bonds are going to usually just keep creeping up that staircase for a decade at a time. But we want to pair that with the defense in case those bad things happen where markets sell off or, we have an inflationary environment. And so when you think about what does that look like on a positioning level, that's when it becomes a little more nuanced or difficult. But in general, in the long volatility and tail risk bucket, like I said, we're allocating to 14 managers there. And the idea is we want to cover a lot of the different ways that sell-off can occur. There's a lot of different path dependencies to a sell-off. By having an ensemble approach to that, we make sure that when the sell-off happens, even if 4 out of our 10 managers miss it, and 10 out of 14 monetize it correctly, we're at least capturing the bulk of that move. Because if it happens once every 10 years, we cannot miss it. We need to make sure we get that. And I think a lot of people have been burned in the past because they tried to pick the best long volatility tail risk manager, and maybe they didn't monetize it correctly, and they get burned by the space. So that's almost just like microcap or value guys. I'm really worried about downside risk, even when it comes to building this portfolio. Is why I believe in ensembles. And then on the commodity trend side, we're up to 24 managers now. And the idea there too is there's a huge dispersion of returns in commodity trend following. And it has to do a lot of times with their look back periods. Are they long look backs, medium or short term look backs, which leads to their trading style, short, medium, long term. And so you get a lot of dispersions, like in a 2020 environment, typically, commodity trend following will typically do well in recessions or inflationary environments. And that's why it's a nice 1-2 punch with long volatility, because if you have an acute sell-off like March 2020, long volatility and tail risk really kicks in that convexity, right? When everybody's on the wrong side of those trades and everybody's just going to cash, everybody's throwing the baby out with the bathwater, correlations go to 1. Long volatility tail risk is great for that. If you have a more protracted recession where the stock market is just dripping down, you don't get that pop in volatility that you're looking for to get that convex return. But because of the ability to go long and short the markets the way commodity trend followers do, they tend to do well in kind of protracted recessions. And then because we talked about the commodity inputs, they tend to do much better in an inflationary environment or have a higher beta inflation. So in 2022, that's what they did well in both sides, right? Like they're getting that protracted recession and they're getting an inflationary environment. And that's why they did exceedingly well in 22. But then, when you get risk on back on, that's where you're going to see kind of drawdowns in there. And so it's a really, once again, trying to build a beta-like signal out of those using that ensemble approach. So if I think like I'm getting a beta to global stocks and global bonds, I'm pairing that equally with the beta to long volatility and commodity trend following. And it's just about trying to think philosophically about pairing those together. And then inside that, we call it like fractal diversification. We just keep going layers and layers of diversification within those layers of diversification.
Perfect. So what's some of your criteria when you're assessing potential manager for allocation? What are some of the things that you're looking for? What makes the most sense to you? What fits the strategy? And then conversely, when do you redeem? Ultimately you have to redeem at some point, right? So, and it's not every situation is when, the fund blows up, of course, right? Like some of them are actually doing quite well and you're like, all right, I gotta maybe take some off the table. So I'd love to hear both sides.
Yeah, I'm going to start with the easier one, then the redemption. It's like how you allocate and how do you go through that due diligence. And one I'll start with also a unique kind of perspective that we have. Like I mentioned, Harry Brown originally would have rebalancing bands, and I love rebalancing bands because like that's I think the easiest way to tackle rebalancing. But because we offer our clients monthly liquidity, we rebalance on a monthly basis across everything. Not only the 4 buckets of our 4 macro quadrants, but then across managers. So we have a monthly rebalancing frequency. So that's one way that we either add or subtract from managers is just that forced rebalance to like the equal original allocation. And we use a proprietary kind of risk metric that, takes into account their drawdowns, length of drawdowns, Sortino ratios, kind of all the MAR ratios, all of those sorts of things that we kind of put in the mix. But it's more centered on downside. We don't care about the upside volatility. We all love upside volatility, so we'll take that part of the book. How we allocate to managers, it's really specific to those two kind of strategies. On the long volatility and tail risk side, as I mentioned, like we have what's nice about being a quote unquote institutional allocator is these hedge funds. I think retail or people that never really looked into hedge funds don't realize like hedge funds are not about just trying to produce the best returns and go anywhere and do anything. At the institutional level, they do one very niche, narrow segment of a strategy, and then the institutional allocators like to put those together. So it's not like so you might have a manager that actually is trying to lose money, but provide unbelievable convexity for a sell-off, right? And people are like, why would you allocate to somebody who loses money? Is like, because they're building that convexity in that inventory for when we need it most. So when we look at long volatility and tail risk, it's more about those paths of moneyness from right at the money to out of the money to deep out of the money. And we like to overlay those paths of moneyness. And if just like any sort of insurance, that costs money. So we look at managers that are trying to either actively trade that. They're looking for like a forest fire to spark off, right? They're looking, I know you're in California, but the wind conditions, the underbrush, how long has it been since it's rained, lightning strikes.
I'm a surfer. You're talking my language. All I focus is on forecasting out here.
Exactly.
Yeah.
So they're looking for those times when it looks like a forest fire could spark off. And that's how they're trying to reduce that premium spend. They're trying to just get in the market when you need it most. But because of that, what if they miss that, right? And that's why we look to overlay and overlap them. And then we also have those permanently on tail risk puts that we're just permanently buying every quarter and rolling those in case something happens over a weekend or something like that. What even we just saw recently with the Nikkei going down on August 5th is those are the things we're trying to manage on that side. But because that, costs money for that premium, the other way we try to manage that is we use relative value volatility strategies that are more like pairs trades. And hopefully that provides a little bit of income, but they can also still be long those tails. To give us help pay for that premium bleed over time. And then the other way we look at it is when March 2020 happens, you have implied volatility expands and it costs a lot higher premiums now for you to be able to cover those tail risks. So we like managers that can just intraday short the stock indices around the world. So it's just another way to kind of play that where they don't have to pay up for that implied volatility, or you can think about it as higher premium because now everybody's worried about that risk. So it's just thinking about overlaying primarily the paths of moneyness to make sure we have that convexity and that sell-off, but more different, it's also their monetization heuristics are all going to be different. So like I said, I'm just trying to capture the meat of that move and make sure we catch it when it does happen. And then thinking about different environments where, after the sell-off, pre-sell-off, how do you pay for those things? That's the way we kind of look at the long volatility bucket. So it's really about building in those niche managers for things we're looking for. And we always talk to managers, it's like, look, everybody's trying to make money, but it's like, show us where you get hurt, where you lose money. And then I can overlay that with another manager that makes money in there. And over time, like hopefully that rebalances and works itself out. And then on the commodity trend side, like I said, there's huge dispersion in that space, but it primarily comes between those trading frequencies, like short, medium, long term. So we start with those buckets, right? We tranche them into buckets of short, medium, long term. Then we look for managers. They might be doing slightly different strategies, whether they're using moving average crossovers to go long on trend or short on trend, where they use a breakout model, whether they volatility target their positions to smooth out that, or they just let the positions ride. Inside those buckets, that's what I'm saying. We start using that kind of fractal diversification, and that's how we think about it. And then to answer your hardest question, and I don't think there is a great answer for this, and this is why people try to gloss over it and not talk about it, is like, how do you cut managers? And so, for example, I said at the beginning, we track about 35 vol managers, allocate to 14. And part of that, and similarly in the commodity trend space as well, is they're like Lego pieces to me, right? Like I can mix and match and plug and play as maybe managers coming out of the market. Or as I said, when we started with just $5 million. And as our AUM has grown over the last subsequent years, the more AUM we manage, the more we can maybe get into better and better managers. They might not necessarily be better, but like you get that idea, or the more diversification we can get. And so the way I've always kind of looked at it is like fantasy sports betting with like football is you have wide receiver 3, 2, 1, right? And maybe at their lower AUM, we were in wide receivers 3, and then I moved up to 2s and 1s, or we're just, broadening out that diversification to make sure we're covered. So that gives you an idea of where we're kind of moving the allocations to. But then the question is, when do you cut managers? And, fortunately or unfortunately, we've had some managers that basically cut themselves, right? That's the hard part. Like we talked about running this business, is people get redemptions. And what I found, this is why I built what we built, is, we have over 300 clients. And to me, that's a broad diversification of clients. As an entrepreneur, I know that's best for my business. Where most people in our space, they want the institutional allocators that are going to cut them like a $500 million check, right? But if they're running like 200 million with maybe 5 clients, they get one client to come in and write a 500 million or $1 billion check. Now they have an 800-pound gorilla. They have to staff up for that and everything. And if for whatever reason somebody changes seats at that institutional allocator or whatever, they lose that redemption, they're usually out of business. And so that's what we've kind of seen over time is so I was always trying to broadly diversify so we didn't have that problem. But we've seen some managers go out of business, so we have to replace them. But then the harder one is, like you said, how do you cut them? And you try not to focus on returns, right? But we all can't help it, right? If somebody's making money, we're usually, we're happy with it. And, we might gloss over some of our qualms or our indications that something we should look into. But like when they're in drawdown, that's when all of a sudden we remember all the bad things they did, so that you got to kind of manage your behavioral aspects that way. The other thing, we actually had one of our managers, once we started with them, they had a great quarter. And I called them up and I was like, you actually are like, probably 1.7 standard deviations, higher than you normally are in a quarter. Like, are you taking too much risk? What should I be concerned about? They're like, you're the only client that called us because we were making too much money. And so, so that's what we just try to make sure, and kind of just check in with all of them all the time. The other thing we do is like, so there's 2 ways to look at it. If you think about pod shops, right? Pod shops are notoriously like, if you have a 5% drawdown, you're cut, you're out. That's how they manage risk. And then you have like, value investors, et cetera. They have what my friend Jerry Parker calls loose pants, right? Like you can take a 30, 40% drawdown because they're counting on mean reversion. And the problem is both of those scenarios are correct. Both work. Like you can either cut managers at a negative 5% drawdown and do fine, or you can allow managers, if you believe that mean reversion will happen and they're still doing a good process, you can take advantage of that mean reversion as well. The problem is like kind of when we do an in-between, when we split ourselves, is like where we don't cut them at the 5% drawdown, they get to the 30% drawdown, then we panic and fire them. So those are the things to worry about. But that's the hardest piece is like, every environment's different. So like you're talking to your managers, they have this great back test, right? They've been doing so well, for the last 10, 20 years. The hardest thing is your worst drawdown's always ahead of you, right? So they go into their worst drawdown and then you're re-underwriting. You're like, is your process and your system still the same? And do I believe in it? And is it good for this macro environment? So that's the really hard one, because I've had managers where like, see, we hired them for a very specific strategy. I know that quarter, that year was very fruitful for that strategy and they lost money. Well, it's like, you didn't do your job. That's an easy cut. The harder ones, like you said, they're doing their job. They're just hitting their max drawdown. Do you still believe in them? Those are really hard behavioral issues, especially in my seat, is like, how do you manage yourself through that? I think it's exceedingly difficult. And I don't think anybody has the right answer. And I think it's one of the biggest problems in our industry that nobody likes to talk about. It's really tough.
Let's dig into it a little bit more. How do you manage it? Personally, when you're like, all right, I know I got to make a tough decision right now, for one reason or another, whether it's just underperformance, outperformance, what goes through your mind when you're finally like, all right, here we are. This is how we arrived here. This is what we got to do.
Yeah. So I think it was maybe
just to be
Yeah.
clear on the questions so that listening, so I'm not talking in hyperbole. This is when we're to cut a manager, and
Yeah.
understanding the decision
Yeah.
process around that.
Well, I think even and similar to what you guys do, I think it was maybe on your podcast with David Bastian from Kingdom, when you guys were talked about like you want to be you want to get to know management at an equity, but you don't want to become too friendly because then it's hard to cut your friends,
Yep.
right?
Yep.
And so it's very similar in our industry in that way. And but we actually have to show you nobody does due diligence. We have like a 140-page PPM, private placement memorandum that we have to give our clients and they sign it and everything. But like it's on like page like 72. We have an Easter egg in there that says basically like Jason's an autistic asshole that will cut his best friend if he has to, like just to see if anybody notices, right? But that's the way you kind of have to look at it. It's so hard. It's like you get friends in this business. It's inevitable, but it is, at the end of the day, it is just business. And I think, like I said, the easiest ones are like, are you doing your specific strategy that you sold us on that you're continuing to do? Is it just a bad environment for that? Do we think the environment will come back? Like all that stuff's easier. The harder part is like it's just the cutting. The other one easy on the cutting, right, is like if you get hints of smoke of like fraud or whatever, that's an easy cut too. So then like there's a lot of like easier cuts that everybody always talks about. Then the harder one is like, what if they're doing what they're doing? They're just in drawdown. You got to stick with them. And like if you believe in the environment, the system they're running, the people in the process there, like you just got to stick with it and you just got to grin and bear your teeth. But at the same time, if you think about it, what made it always easier on myself is I knew this was the case. So there's a couple of things we do. One, we get separately managed accounts with all our managers, so we get to see their trading in real time. So like if somebody's supposed to be buying volatility and or tail risk options and they I don't know, they go crazy and start selling volatility, we can see that account and go to cash immediately, right? Like so we have that overlay, and to me that's the only proper due diligence you can truly have is to have those SMAs so you don't, have like a Bertie Madoff type scenario. You at least get to see their trading in real time. Beyond that, the only other due diligence you truly have is position sizing. And so that's how I think about it most. And that's what takes a lot of that stress off of me as far as making those decisions. If, the vast majority of my managers are probably only running anywhere between 5 and 7%. So one, I'm rebalancing them every month, but also when one's hitting max drawdown, one might be hitting max gain. And so you're kind of rebalancing from those winners to those losers. So you're hopefully gaining a little bit of rebalancing premium over time, but it also makes it so that that drawdown's not quite as painful. And then our force rebalancing forces me behaviorally because it's our mandate to force those rebalances on the monthly basis as well. So it's like it was thinking kind of through a lot of those processes and issues before we even started a fund of how do we almost put the gates and the systems in place for our own behavioral errors. But at the end of the day, I will admit, I am sure over time there's going to be managers I cut or stick with that were a bad decision.
Mm-hmm.
And I just don't think there's any other way, or there's no other way around it. Like it's just like position sizing. I'm sure that you deal with your own portfolios. It's like everybody wants to like. I think we should all talk about position sizing, but it's always funny to me. It's only after the fact that it was either too large or too small based on the outcome. That's what we beat ourselves up for when we can't do that. It's the process. Like this is how the position size I should have taken. If it makes a lot of money, you're like, oh, that position was too small. If it loses too much money, you're like, that position was too big. So we're never ever going to have the right position sizing, but we have to kind of try our best to get that out of our head and just think about process over outcome.
So here's a question for you. We at our Las Vegas event, we actually did something called an institutional allocator, or we did an allocator power hour kind of thing,
Yeah.
where we had some institutional allocators meet with managers to assess, whether or not they wanted to, be institutional shareholders in their fund. And one of the feedback things that I got actually from some of the managers is that some of them were like, yeah, I'll participate, but I don't know if I'm all that's really want to have an institutional allocator as one of my clients potentially. There's a lot, that's not to say they don't believe in their strategy or anything, but some of them, they see it as a headache. So have you ever had an experience where a manager looked at you and be like, Jason, you seem awesome, I like what you're doing, but I really would rather not work with an allocator as one of my clients, for whatever reason. Have you had an experience like that?
Yes and no. I mean, from our perspective, usually like I said, a lot of our managers have like $100 million minimums or $10 million minimums, right? But they're human beings and they know that a lot of their family and friends can't access them, you know? So like they're actually really happy about what we do. And most of them, I built relationships over the years to bring those minimums down, right? Like I'm beating them up and they're like, this is why you need to work with us. And like, they love that we're this megaphone mouthpiece to the world about like long volatility, commodity trend, tail risk, like similar that you are this, you know, this megaphone for them. So we usually get ones that want to work with us. And then we try to be like most institutions, you know, they say permanent capital. I'd kind of disagree with that, but hopefully it's better capital and more consistent capital over time. And as our AUM grows, their AUM grows. So that's kind of the pitch I make kind of up and down that chain. But what I can see for, you know, microcap stock pickers, and Brian Bears has talked about this too, because he went like purely institutional, is like the regulatory burden and the reporting is really high working with institutional allocators. And so it's very difficult. Not only that, there's usually a 2 to 3 year sales cycle with a really large allocator. And so that's one, why we stayed away from it. But two, I always knew none of the institutions are going to allocate to us because they like to choose their own adventure, and we're kind of packaging up more for like the retail clients. But that's why I always have these great conversations with pensions and endowments, because I know they're never going to allocate to us. So I'm always honest with them. But like they go through like this 2 to 3 year period of due diligence, right? And a lot of it's performative. And a lot of that, like we're saying, is like it's really annoying if you're a microcap stock picker and you're spending 70% of your time in compliance meetings and due diligence, right? Like that's what people have to think about. These are like the dark arts of the back, you know, the back end of our industry that nobody sees. So I can understand why people wouldn't necessarily want to work with an institutional allocator. But then at the flip side, as you know, there's a lot of great stories where institutional allocators have stuck with small managers for 10, 20, 40 years. And it's been this unbelievably symbiotic relationship. And more importantly, I think, you know, it was a different environment when Brian Bear started. He also talks about like once you get that first institutional allocator in the door, it opens up, it unlocks that J curve of now all the other pile in. And so it's a little bit of a column A and column B, and it's just a kind of like what kind of business are you trying to run? You know, what kind of people are you trying to get in there? What I find best probably for microcap and for what we do is like those smaller family offices do really well. Like, and Ian and Cassel and I have talked about this a million times. That's what his bread and butter is too. It's like, as long as you have that first generation decision maker, that first generation entrepreneur in there, we can usually talk in, mano a mano about really interesting ways and interesting thought processes. But as soon as like they built the institutional infrastructure around there, and it's somebody maybe not from the family or second or third generation, a lot of time that's harder for them to really understand like how we're trying to really protect, hedge, do our due diligence. So like I think there's a sweet spot there with the smaller family offices, and then the good side of that is like that's probably the biggest growing or fastest growing asset pool right now is family offices.
Mm-hmm. Absolutely. You know, here's a question I probably should have asked like a half hour ago, but I'm gonna ask it now. Why did you want to go on the allocator side versus just building out your own, deploying the strategy? You could use more or less the same cockroach strategy to, buy and sell individual asset classes versus going the allocator route. So, like I said, I should have asked that a half hour ago.
No, it's great because we're in this weird hybrid model. Like I find this when I go to events sometimes is like we're both an allocator and yet we kind of like run a strategy as well. So we're like an individual hedge fund, so to speak, and then we're also an allocator. So I get to kind of sit in both seats and kind of see that. And to your point, yeah, like I could have built all this out and traded it all in-house, but there's a couple of reasons why I didn't decide not to do that. One, I had to admit to myself, which was very hard to admit to myself, that I'm probably a better entrepreneur than I am trader. And that's really hard for a lot of people to try to finally come to terms with, because I see a lot of my friends in the industry that want to be both the trader, the entrepreneur, and the public intellectual, and that's just splitting yourself into too many pieces. The other part of it was specifically what we were looking for. Like I keep going into, there's so many path dependencies to like these defensive assets. Like in the derivative space, it's very unique. And to me, it's like the last bastion of active management. And so you want that broad diversification. You go, okay, if you have that viewpoint, you could do that yourself, right? You could think about broad diversification. But if we're honest with ourselves, we have very idiosyncratic philosophies and life paths that make us think in a very, narrow niche way. And so to me, this is why I like working with outside managers that have niche strategies, but also maybe think differently and have, they're cognitively different from the way I would put together a portfolio, because that allows me to truly get that broad diversification. Like a lot of times I find when, like we said, if a hedge fund starts out in a very narrow niche, they do really well at it, right? And then they want to grow more AUM, so they get bigger and they start implementing different strategies and everything. And they go, well, I'm broadly diversified. I find at the top, whether it's even encoded in there, it came from a human in the first place, but it's usually one person's thinking or that investment committee thinking, and you get groupthink. And even if they trade both long volatility, short volatility, et cetera, it's going to have a very similar viewpoint. and that can lead to kind of some destructive kind of drawdowns or issues there because of that singular way of thinking. And I think the broad diversification works much better. And then if we're you and I talked about before, this is a therapy session before we start recording, we were talking about just different personal stuff, but like if I'm honest too, like I'm probably getting too old to stare at a Bloomberg all day.
Fair. I totally get that part.
Yeah.
So this is a question that I ask everybody on here. So I'm gonna adjust it a little bit based on your experience and everything that we talked about here today. What would you say was an experience, let's say specifically with the manager, that kind of changed, maybe not necessarily the trajectory of the approach, but it could also conversely that let's say it's solidified that you're going down the right path and this is the approach that you want to take. Love to hear that, if you have an experience or two that maybe on both sides that you're like, oh, we needed to adjust this part of the Cockroach strategy, or, hey, oh, you know what? We just made a decision here that totally supports exactly what we're trying to do here.
No, that's a phenomenal question. I'm thinking of all the different ways I attack it, but I also want to take a step back for a second. The other reason why we do what we do at both the allocator and instead of running our individual funds is like, to me, like proper portfolio construction is rarely talked about. That's what I'm usually asked to speak about on stage and everything. And it's really interesting to me how few people talk about portfolio construction. And part of portfolio construction is like, this is like the apogee of a liberal arts education. And this is why I love being in that room with microcap investors is I have an insatiable curiosity. Everybody in that room had an insatiable curiosity, right? And so this is one of the reasons why I wanted to also build a multi-strategy platform is I get to go everywhere and do everything. I get to learn about all these niche strategies in every aspect of trading and hedge funds. And so to me, that cognitive challenge and the curiosity that's infinitely insatiable. I'm always talking to some of the brightest minds in the world about specific strategies. So it like every day is different, and that's why I built kind of what I built. I get to have much more interesting conversations that way. Talking about individual managers or what kind of changed our opinions. There's been at a high level that's kind of glossing over your question in a way is like seeing how the diversification works over time. Like when all of a sudden emerging market and foreign, stocks will start to have a run. We're like, yes, thank God we had them in there. And then most of the time they get slammed back down. And everybody's like, why do you have foreign diversification in there? Those are the little things that like remind us why we like the broad diversification. But specifically to your question is like, if I think about the long volatility portfolio, I probably believed a lot more 5-10 years ago that active long volatility management was a great way to go to like kind of reduce that bleed, but be there like when you need it most. And I think over time, I've gotten more accustomed to, I just like that permanently on tail risk, that insurance, and then combining that with relative value volatility strategies. Because, people, talk about, if you're short volatility, you're picking up, pennies in front of a bulldozer and eventually you're going to blow up. But if you're just pure long volatility, a lot of times you'll bleed to death before you ever make money. So the pairing of those two being relative value volatility and just looking for disturbances in the volatility surface, I really have come to love relative value volatility trading in a way. And then I've really come to love just that permanently on insurance and knowing exactly what my fixed spend is every year. And I've found over time the in between of people really trying to market time, which is honestly, it's kind of anathema to the way I always think, because I actually don't think there is alpha over the long term in general. And so it's kind of surprising that I always believe that these guys could really time the markets. But the way I would think about their timing the market is that I'm packaging them together as like a team of 8. So, hopefully together they'll time the market fairly well in aggregate. But over time, that was probably the biggest portfolio change, is still keeping those managers on, but thinking about the actual allocations to those different sleeves inside that long volatility bucket and going much more towards relative value volatility, pure tail risk, and then maybe lessening some of the approaches to the more active management or active trading around long volatility.
Absolutely. So, look, there's a bunch of topics that we didn't even get to today because I've been so enjoying just how you built the business and understanding your thought process on how you pick managers, how you cut managers. Because, I've had institutional allocators on before and we talk about it quite a bit. We've talked about it there too, but I find it's mostly just on the microcap allocation side. We haven't talked about it broadly with somebody that looks at all different types of managers out there. So I really appreciate you going through all that with us. So with the interest of time, because I'm trying not to go over an hour,
You're fine.
Love to get some final thoughts. What are you thinking about currently? Maybe what are some things that have been piquing your interest? Let's say, other than obviously, your deep dive in microcast, because why not, right? Here we are, you just in Idaho, whatnot. But what's been piquing your interest currently? And then I'm sure you'll come back at a certain point. We'll cover a whole bunch of other stuff.
Yeah, I mean, one, I was telling you that this whole micro cap world's fascinating to me because I'm an entrepreneur, so I'm incredibly, optimistic. And then I run a defense portfolio, so everybody thinks I'm pessimistic. So like when I'm hearing those pitches, I'm like, every one of them sounds great. Like, please take my money. But then I come back to that. My bipolar pessimism is like the thousands of hours I would have to do to figure out, if this is, real or not would just, it's too much time. So it's like, it was great to be part of it, but then trying to like, keep my distance from it in a way. One of the things I'm interested in, we're working on is like, speaking of like micro cap space, is like what we built on this commodities managed future side means, like I said, we can't necessarily trade securities. And to me, that's kind of one of the missing pieces to our portfolio. But then like regulatory wise and cost burden and compliance, makes it difficult for us to cross over. But I'm always trying to figure out the solutions, like what's the right wrapper and vehicle, for this. And that's what I talked to a lot of the guys out when we were in Utah. I'm sorry, Idaho. And the idea I've been marinating on and doing a lot of due diligence on is like the interval mutual fund. And it's a very interesting vehicle over time. So I'm trying to get to know the players, the cost, everything in there, because I would love to be able to add some security side. Like I think about it like right now, my stocks bucket is just global stock indices, right? And so even in the U.S., right, we're gonna have S&P, NASDAQ, Russell in there because that's the managed futures indices. But like I talk to Ian all the time. I would love to have like micro cap in there, small cap, mid cap, like, and really diversify in that. But what's interesting to me when I was talking to Ian about it, like, and even the guys at Kingdom is like, they find that people that want to allocate to multiple people in the space, they actually don't like it. And I was like, why? I was like, that's my ensemble approach is like, I would allocate to several of you because I want that diversification and I want a lot of positions on. And then over time, we're hopefully going to grow together. And they told me that like the people that have done it historically are just trying to look their best ideas and play them off against each other and constantly questioning them. Like, this person has this stock on, why don't you have that? And I'm like, oh, that's not like, I don't tell my managers what to do, right? I do a lot of work, pre-done work to make sure, due diligence, what they're doing, everything, get the SMA. But once they're up and running, I don't tell them how to trade. They're going to know way more about that microcap stock than I ever would. So why would I ever put my opinion into that matter? Why my 2 cents is irrelevant in that scenario. So this is one of the things I'm working on, whether it's an interval mutual fund to be able to open up that access to securities so I can get that broader diversification. So then I can spend more time in your world, which I thoroughly enjoyed. But part of that too is we've always said the Cockroach 2.0 version is like, we're in all the liquid asset classes of the world. I want to combine it with all those private investments. So a lot of that, real estate that I come from, private equity, venture capital, catastrophe bonds, farmland, timberland real estate. I think if we can combine our liquid portfolio with that illiquid underlying privates that have a lot of granularity issues when you're trying to invest in them, I think they have a beautiful symbiotic relationship to them. But it's always like I'm pushing the forefront of the boundaries of like what you can do inside these investment vehicle wrappers. So we're always just trying to find the best way we can do it, provide it to our clients that makes it so it's not so it's within reach of our family and friends, and then also make it in a way that has as liquid wrapper as possible, but it's also on the platforms they're looking for it to be on. So like you have all of these different things that you have to weigh and balance in this business that makes it tough to not just be able to be everyone to everything. But that's what we're working on to the future, is like, what does the future Cockroach 2.0 look like?
Very cool. I think that's a perfect place to end it. So, I mean, Jason, with that, where can our audience go and find more information about Mutiny Funds, follow you on social media, and then also listen to your podcast?
Yeah, you can find us at mutinyfund.com. It's singular for there, but like we put out tons of great essays on there. And some ones we were joking about before we didn't get to. And then our Mutiny Investing podcast, you can find it on there as well. And also on our site, we just put out an 80+ page white paper for free that goes into this entire cockroach philosophy, dives into each kind of bucket of how to think about stocks, bonds, volatility, commodity, and the entire history of it. We're really proud of that. Spent a few years on that, but it's really, decades of thinking that's gone into that. And then on X Twitter, you can find me at Jason C. Buck, and all that good stuff. Feel free to reach out. Any questions? I'm always happy to discuss all aspects of a multi-strategy space.
For sure. And you will thoroughly enjoy the white paper. I haven't gone through the whole thing yet. I've gone through a little bit, and You will enjoy every single shout out to every rapper of the last like 30 years between 50 Cent, the Get Rich and Don't Die Trying, and
Yeah.
just right there on the cover with Tupac. So, Jason, thank you for joining me, man. This was so much fun. I'm sure I'll have you back on at some point, but good luck, stay safe, and I look forward to our next conversation.
Thanks, Bobby.